Markets are entering the second half of 2024 in a holiday-shortened week at home and in the United States. Oil has been trading near its highest in 2 months. Markets, of course, also weighing the US Fed chair's comments that the central bank needs more confidence on inflation before starting to cut rates. Let's get more on this from Garnet Anderson, VP and Head of Portfolio Manager at Tacita Capital. Great to see you.
Good morning.
Oil, what are your thoughts? Is it headed higher from here?
Well, it could edge up higher. I mean, what we have a hurricane. We've got tight global supply demand. We've got OPEC, cutting back and continue to cut back theirs. You have the fracas in the Middle East, unfortunately. Mm-hmm. All that's, and you've got really a less than capacity filled Strategic Petroleum Reserve stateside. So you've got a number of factors affecting it. So how could it become a little bit more permanent? Okay. Well, if the hurricane were to hit refining functionality down in the States, that can be problematic because that can take quite a few months to repair. So that could filter through the inflation numbers. But otherwise, hard pressed to see where OPEC right now is going to go and cut further given the Saudis and their spending plans and such. And in the Middle East, unfortunately, it's pretty foggy to be able to see through what might occur, unfortunately, in that theater. So I think the biggest thing is, how does it filter through to inflation? Well, central bankers. First of all, they tend to look at core, which are X energy cost. Okay. Now, ultimately, energy costs do filter through into core through transportation, so on and so forth. But so that's likely to be muted out in terms of what the central bankers are thinking as a result of a 2-month high. But it does hit the household and affordability. But at this stage, we also should recognize a seasonal factor. You go back to post-COVID, the summer driving season in the States, and the recalibrating of the gas that we use. You always seen these spikes in the middle of the summer. So when you take a look at it year over year, it's not that bad. When you take a look now versus January, you're going, oh my goodness, I just lost a couple extra dollars in my wallet. But year over year, it's not that bad.
Gasoline prices.
Gasoline prices, yes.
Yeah, of course, Israel is saying 18 soldiers injured by a Hezbollah drone strike.
Well, yeah, I mean, that's, again, when I talk about the unpredictability of what could happen over there and the tragedy that's happening over there and has happened over there, where that goes, greater minds than mine, I'm not sure, no, either.
The Fed chair still sounding cautious. He doesn't see the case copper-clad for cutting rates yet. Well, yes. I mean, first of all, we come back to energy, and you go back to the 70s. What does every central banker have nightmares of? A replay of the 70s. Right. Where, inflation ramps up, comes back down. They think they've conquered it. They go from one OPEC crisis to another oil crisis, comes back up. We have Volcker and 20% interest rates or whatever it was. So obviously that's what they're all trying to avoid, go down in the history books as that. Unlikely to see that unfold now, particularly with more energy independence in North America than we had back then. So that's the energy side. You have the job side. We saw some, this morning, some JOLTS data coming out in terms of jobs opening. That was a little bit of a surprise. On the upside, perhaps the dull sheen to that was a lot of that was government jobs as opposed to pure industry jobs and service jobs. But a job is a job is a job, and so it's nice to see a little perking up there. So the employment market stateside still remains relatively tight, not as tight as it was. You're seeing, weekless claims remain pretty muted. You're seeing wage growth trend down, but certainly not plummeting. We saw the quits today numbers, the JOLTS quits. That was still elevated. So U.S. workers are still having confidence to move jobs. And, be it for home affordability or job opportunity, they're quitting and moving on to the next job, about 2.2%. You have some investment ideas for you, starting off with Canadian utilities, names such as Fortis, Emera, and Hydro One. Right, well, let's go back to the premise there. The U.S. market, led by the Mag 7, has been on fire. And that has likely led to some unbalanced portfolios out there. And it's hard to let go of winners. I mean, for corporations, Canadian corporations, given our change in our capital gain inclusion rate, probably would have seen some trimming going back over the past month or so, but now it's the individual's turn. And so should they be pulling back and just tweaking up their low volatility exposure? Not because they're going to get the old Peter Lynch 10 banger out of the utility. That's not what it is. It's instead of taking the chips off the table, So they sit there and say, look, I should redeploy some of those chips, get some of the names that dampen the downside. So utilities or property casualty, you go down to the States, you've got healthcare providers. There's certain areas where you can place capital that you don't tend to experience the full downdraft if we hit bumpy times. And for me, it says, nothing going with the Mag 7. Let's go back to 2022. They're off about 40%. The rest of the S&P off about 8%. So it can happen. The earnings are starting to come back to the pack a little bit. They've been extraordinary, but starting to come back to the pack a little bit.
I'm just looking here. Over a decade, the TSX has doubled your money almost over a decade, including dividends, at 95%. But Fortis, and this is over 10 years, so it's a long period, has given you a return of 140%. And even Emera has been slightly beat the market.
Yeah, even though it's gone through a little bit of challenges, it's kind of rejigging some of its portfolio. And I mean, if you take a look at, you say, Ontario Hydro, okay, so that's your base. Right, and then you say, okay, well, now where can I go for a little bit extra return? Emera would be a little bit more of a comeback story. Fortis would be a continued growth story. Hydro still continues to pump out. I mean, its EPS growth expectations call it the 8%, not 18, not 28, but 8%. Dividend growth, well-positioned, regulated utility. So again, you're not going there for the 10-bagger. You're going there for saying, if I'm wrong, I still want to be in the equity market. Where can I go to get a dampened lower downside?